What's the global economy looking like? Trudging on, in spite of the headwinds of uncertainties around geopolitics, tariffs and trade, climate change, and many more. Earlier today, the latest World Economic Outlook report released at the World Economic Forum in Davos presented a set of growth forecasts across the regions, led in the main by rising investments in technology. Let's take a listen.
To show notable resilience despite significant trade disruptions and heightened uncertainty. According to our latest projections, global growth will hold steady at 3.3% this year, an upward revision of 0.2 percentage points compared to our October estimates, with most of the improvements accounted for by the United States and China. We have repeatedly revised our projections upwards since April of last year. Remarkably, global growth for 2025 and 2026 is expected to be stronger than projected back in October 2024, before the tariff disruptions started, as the global economy shakes off the immediate impact of the tariff shock. This resilience reflects offsetting forces. The trade tensions constitute a major source of instability, as events of the last few days illustrated, but other factors helped. Great agility of the private sector, which kept supply chains smoothly functioning, supportive financial conditions amid a tech AI investment boom, and stronger stimulus in some countries, especially China and Germany. Now, global inflation will continue to decrease from 4.1% in 2025 to 3.8% this year and 3.4% in 2027. Even if it remains above central bank targets for many advanced, emerging, and developing economies this year. Despite this, risks remain tilted to the downside. And let me mention a few areas of concern. First, growth is concentrated in a few sectors, especially in information technology and artificial intelligence. The IT boom has also been concentrated in the US, where IT investment as a share of output has surged to an all-time high. This is generating positive spillovers globally through high demand for technology goods, most notably from Asia. The IT boom has been supported by favorable financial conditions, helping to fund new capital spending. But as the expansion accelerates, debt financing is becoming more prevalent, which could amplify shocks if returns fail to materialize. The comparison to the 1995-2000 dot-com boom, which I have pointed to already back in October, is instructive. Our analysis suggests that the potential overvaluation of the US equity market remains modest so far compared to the dot-com episode. We have previously shown that a moderate correction in AI stock valuations, coupled with tighter financial conditions, could reduce global output by 0.4% in 2026. Yet the impact of a correction could still be broad for three reasons. First, many critical AI firms are not listed, and their debt borrowing could be consequential. Second, US equity market capitalization is much higher now relative to output, so a correction could have a larger effect on consumption. Third, foreign investors' holdings of US equities have increased significantly in recent years, increasing the risk of global spillovers. Now, of course, the current tech boom also offers the promise of increased productivity. And should these gains materialize, we estimate global output could increase by 0.3% in 2026. Now, another source of fragility is the cooling of labor markets, with unemployment rates rising above their natural rate in many countries. This raises the question of how broadly distributed the gains from economic growth are. In the US, where the labor share is at an all-time low, despite strong productivity gains, concerns are rising that AI could well displace many workers.